Hello and welcome to my channel. Today I'm going to talk about some of the allowable property expenses. As a property tax expert, I see people asking a lot of questions about what expenses can they deduct from their income. And with that in mind, I decided to make this video to clear things up for the people who aren't sure what they can and what they can't claim. I can't cover everything, but I am going to cover some stuff for you, and there are three general principles that all expenditure must satisfy in order to be allowable. The first one is there must be actual expenditure incurred by a person or an entity. The second is that the expenditure must be incurred for the purposes of, in this example, their property business. And the third is the expenditure must be wholly and exclusively incurred for the purposes of their business. Now you have an option where you can use the accruals basis or the simplified cash basis or the cash basis itself. Under the accruals basis, the amount paid in relation to the expenses incurred in the tax year is irrelevant. It is the amount of that expenditure that relates to the tax year that is key. Under the simplified cash basis, income is recognized when it is actually received by a business or a business owner, and the expenditure is recognized when the actual expense has been paid. If cash has been paid out or cash has come in, you record it and allow for it. If you're an invoice basis, as long as you have an invoice, whether it's paid or not, then you have to account for it under the accruals basis. I hope that makes sense. Now, the popular one, revenue versus capital expenditure. One of the most important things to understand is the difference between revenue and capital, and it's a minefield, let me tell you that. In a nutshell, revenue expenditure is deductible from rental income in the year in which it is incurred. Capital expenditure is not deductible from rental income, but it may be allowable as an enhancement expenditure when computing a gain, which is then for capital gains tax purposes, and some capital expenditure may qualify for capital allowances. We then move on to repairs versus improvements. Repairs are allowable as a revenue expense against your property income, but the cost of capital improvements is not. A repair, generally speaking, I'm keeping this very simple by the way, is a restoration or replacement of a particular part of a building or a house rather than of the whole building at one time. A capital improvement goes beyond a repair and it's more than just replacing like for like. It can be like for like, but it usually is an improvement stroke enhancement, and it adds to the value of the property or enhances the value of the property, generally speaking. The key consideration in determining whether expenditure is a repair or a renewal and whether it's allowable as a deduction for tax purposes is whether it is capital or revenue in nature. In some cases, it can be, let's say, relatively straightforward to identify revenue repairs such as exterior and interior painting, decorating, damp, rot treatment, mending broken windows, doors, furniture, plant machinery equipment, for example. In other cases, the distinction can be, let's say, not as clear. Where an expense enhances, expands or improves the value of an asset, it is a sum employed as capital in the business and the expense is disallowed, so you can't claim it against your income for tax purposes, or it's not a tax deductible expense. When analysing expenditure incurred on repairs and renewals for tax purposes, it is likely that four categories will be relevant. Number one, deduct as revenue. Number two, disallowed as capital but qualifies for capital allowances. Number three, potentially adding to the base cost for capital gains tax purposes on subsequent disposals when you have to sell the property. And number four, for small businesses, disallowable for failing the wholly and exclusively test, which I covered for you earlier. In most cases where a trading asset is repaired, it will meet the requirement for the expenditure to be incurred wholly and exclusively for the purpose of a trade. And remember that there is also something called duality of purpose, so it has more than one purposes, but I'm not going to cover that for you today because otherwise it's just going to get even more complicated and comprehensive. I'm trying to keep it as simple as I can for you. And when an asset does have a mixed use, i.e. it could be, let's say, for personal and business purposes, any repairs associated with those assets may be considered to have a duality of purpose, like I covered a few seconds ago. Small businesses which are operated from an owner's home will typically have issues regarding this, and that's something that you need to differentiate and be clear on. And that's it for today. I hope this short video has been helpful in explaining some of the allowable expenditure, even though I've kept it very broad for you, because if you go into too much detail, then different things apply to different people and it complicates it. Whereas if you can understand the principle and then apply the principle, it makes it easier. Any questions, comments below, click like if you like the video, subscribe, and thanks for watching.